Hey there, guys. So this is going to be a lesson on what I call the rule of fours. So to get a very detailed kind of reading of one of the topics that I kind of go over, it is on my website at oddstocktrader.com. It's listed under the blog under rule of fours. Now, kind of what this means, it's a strategy that I use to trade. And essentially, it is being able to predict these price movements based off of current market action, being able to see it live and be able to kind of pick your spots better as far as entries, exits, finding the top, finding the bottom. So I did write a detailed blog post on this on my website, which I will link in the description below as well. So if you want to, go ahead and feel free and give that a read as well if you want to get a little bit better of an idea of what I'm talking about. Kind of use a lot of examples, but I'm going to go ahead and use some of the recent examples as well, kind of with what I mean by the rule of fours. So here we have a chart of SPHS. This obviously had a pretty big move today to the downside and to the upside from basically low mid fives up to 850s or so. Now this strategy can be used both ways. And how you can determine this is moves 1 and 2 usually are going to be the same size as far as dollar movement in that specific direction. Now, what do I mean by that? Essentially take a low, bring it up to one of the peaks on a violent movement to either the upside or the downside. So you got 570s here, $7 there. So you can kind of say $1.30. So $1.30 from the next low is going to be $7.80 or so. So right about here. And that's pretty accurate as far as that next push. So those first two moves are usually the same distance. Moves number 3 and number 4 are usually a little bit smaller. So you can see how it bases here at 740s. And then it ramps up to the next one, which is 820s. So 740s, 820s. And then I would expect that next move up, if it is that final true fourth move, to be even less. Sometimes about 50% of that third move to the upside on the fourth side. So it's not always exact, it's not always perfect, but it does give you a very good indication of where tops can be formed. And especially with the double top there on this particular chart, it is signaling the top. Now, you can use this again to the downside. So, it finally showed its crack, and you can take this peak here, 814s, 815s, and its first violent move to the downside is about $1.50 or so. So then take the next peak, which is here. $1.50 from there is going to be what? I think that's about it's about 640 or 630 or so, somewhere around there. But essentially it makes almost the same distance move to the downside as this first next move. And that's the point that I'm getting across. It's not always exact, but it is pretty determinative as far as this move here and this move here are very close in dollar size together. Then you have the third move and then the fourth move, and that kind of signals that bottom. And like I said, it's not always exact, but it does give you a very good indication. And this final wash can be big. It can be a different size, but that is more of an area of interest that I would be in if I was looking to either long this on the dip or short this once it does make that move to the upside. And here we have a chart of the SPY. So, and a lot of people would say, oh, well, that's just a penny stock and it's not going to do those specific moves. It's actually not true. It can be used, and I detailed this one on my blog as well, that this move, as far as on the SPY in 2008, all the way down to the low in 2009, essentially followed this rule. And so you can kind of take a look at where that first crack occurred, its distance of the move from here to here, essentially take those peaks and then add those up. The peak, add it up. And what you can do with that is then kind of take a bias as far as what is that next likely distance of that move. Obviously, there's a lot of emotion involved in here. So you can kind of consider this 1, 2, and then 3 was actually the big move. And this washout was number 4. Obviously, when there's a lot of panic in the market, overall, sometimes it doesn't play out exactly. But the point is to get a good entry point. And you can see here right about $72 at that point that was a decent entry with, per se, knife catching. And even if you were to get long on the market here and maybe you panic out here and then it reversed back to that area, you could still get back in. So that's kind of the point and the philosophy behind this, is that these moves are usually generated by humans. Humans are very repetitive. We do the same things over and over again. So you will see that a lot, and a lot on different charts. So hopefully you got some information out about this. If you guys have any other questions, feel free to contact me in my email, which will be in the link below. Also, if you're looking to get a little bit more information, I do trade at Investors Underground as well. The link to that website will be below as well. So if you guys got some great information on this theory today, and hope you guys enjoyed the video, like and comment below.